You did everything right. I need you to hear that before we go any further. You did everything they told you to do. You went to work. You showed up on time. You put money into your savings account. You did not blow your paycheck on things you did not need. You were responsible. You were disciplined. You were the person that financial advice is supposedly written for. And then one day you looked up and realized that the life your parents bought on one income, you cannot afford on two. The house they purchased at 30, you cannot touch at 40. The retirement they started funding in their 20s, you have not started yet. Because there is nothing left at the end of the month to fund it with. And the thing that is eating you alive is not the struggle itself. It is the math. Because the math does not make sense. You are earning more than your parents earned at your age, even after adjusting for inflation. Your household income is higher. Your education is higher. Your productivity is higher. Every metric that is supposed to predict financial well-being is pointed in the right direction. And yet, you are losing. You are falling behind. You are working harder to afford less, and the gap between what the numbers say your life should look like and what your life actually looks like is widening. Every single year. And nobody will explain why. I want you to sit with that feeling for a moment. The feeling that the game is rigged, but you cannot see the mechanism. The feeling that something is being taken from you, but you cannot identify the thief. The feeling that you are doing the math correctly and the answer is still wrong. Which means the math itself must be broken. Which means someone broke it. Which means someone benefited from breaking it. That feeling is not paranoia. That feeling is pattern recognition. Your brain is detecting a real phenomenon. It has a name. It was identified over 300 years ago by an Irish-French economist named Richard Cantillon. And the reason you have never heard of it is the same reason it works. Let me tell you about Marcus. Marcus is 36. He's an electrician in Phoenix. He's good at his job. He has been in the trade for 14 years. He makes $78,000 a year, which is more than his father ever made in a single year in his entire life. Marcus's father bought a 3-bedroom house in 1993 for $87,000 on an electrician's salary. Marcus has been saving for a down payment for 4 years. The median home price in Phoenix when Marcus started saving was $310,000. The median home price in Phoenix today is over $400,000. Marcus saved $42,000 in 4 years. The house he is trying to buy increased in price by $90,000 in the same 4 years. Marcus saved diligently and fell $48,000 further behind. He did not spend recklessly. He did not make bad decisions. He ran a race where the finish line moved away from him faster than he could run toward it. And when Marcus tells people he feels like the system is rigged, they tell him to make coffee at home. Marcus is not bad with money. Marcus is experiencing the Cantillon Effect. And once I explain what that is, you will never look at a news headline about the economy the same way again. You will understand why asset prices rise faster than wages. You will understand why the rich get richer during the exact same periods when the middle class gets squeezed. You will understand why inflation does not hit everyone equally. And you will understand why the most important theft in the modern economy is one that most people cannot see, cannot name, and have never been taught to look for. Here is what they should have taught you in school, but never did. When new money enters an economy, it does not arrive everywhere at the same time. It does not fall from the sky like rain, landing evenly on every person and every price simultaneously. New money enters the economy at a specific point. It flows to specific people first, and those people get to spend it before prices have adjusted to reflect the new supply of money. By the time the money reaches you, prices have already risen. You get the inflation. They got the purchasing power. The transfer is invisible. It is legal. It is continuous. And it is the single largest wealth transfer mechanism operating in the modern global economy. Richard Cantillon was born in Ireland in the 1680s and spent most of his career in France as a banker and economist. In his only known work, Essai sur la nature du commerce en général, written around 1730 and published after his death, Cantillon made an observation that mainstream economics has spent 3 centuries trying to ignore. He observed that when the money supply increases, the new money does not affect all prices and all people simultaneously. It enters the economy through specific channels. It reaches specific hands first. And those first recipients gain a real economic advantage over everyone else because they can spend the new money at the old prices. As the money circulates outward through the economy, each subsequent recipient receives it after prices have already begun to adjust upward. The last people to receive the new money, or the people who never receive it directly at all, experience only the price increases without any corresponding increase in their own income or wealth. They are made poorer in real terms. Not because they lost money, because the money they already had now buys less. The purchasing power was transferred from them to the first recipients. Cantillon called this the non-neutrality of money. Modern economists call it the Cantillon Effect. Let me make this concrete with numbers. In March 2020, the United States Federal Reserve began the most aggressive monetary expansion in American history. Between March 2020 and March 2022, the Fed's balance sheet expanded from approximately $4.2 trillion to approximately $9 trillion. The M2 money supply, which measures cash, checking deposits, savings deposits, and money market funds, increased by over 40% in roughly 2 years. 40% more dollars entered the system. But those dollars did not arrive in your checking account. They arrived in the financial system. The Fed purchased treasury bonds and mortgage-backed securities from large financial institutions. Those institutions, the primary dealers, the major banks, the hedge funds, the asset managers, received the new dollars first. They did not take those dollars and distribute them evenly across the population. They deployed them into assets. They bought stocks. They bought real estate. They bought corporate bonds. They bought commodities. They bought anything that could be purchased before the rest of the economy realized how many new dollars were now in circulation. Here is what happened next, expressed in numbers that should make you furious. Between January 2020 and December 2021, the S&P 500 rose approximately 45%. The median home price in the United States rose approximately 34%. These are asset prices. They are owned disproportionately by the wealthy. The top 10% of Americans by wealth own approximately 89% of all stocks and approximately 45% of all real estate by value. When asset prices rise by 30 to 45%, the people who own those assets gain trillions of dollars in wealth. During that same period, average hourly wages for non-supervisory workers rose approximately 10%. Consumer prices, as measured by the CPI, rose approximately 9%. That means real wages, wages adjusted for inflation, rose by approximately 1%. The people closest to the money printer gained 30 to 45%. The people furthest from the money printer gained 1%. That is not a market outcome. That is a transfer. The mechanism is the Cantillon effect. The new money entered through the financial system, inflated asset prices first, and by the time it trickled into the real economy as wages and consumer spending, prices had already adjusted upward. You got the inflation. They got the assets. Let me show you this with a single asset class to make the mechanism undeniable. Housing. When the Fed purchased mortgage-backed securities, it drove down mortgage interest rates to historic lows. Rates fell below 3% for a 30-year fixed mortgage. This made borrowing cheaper. But cheaper borrowing does not help everyone equally. It helps people who already own assets and can leverage them. It helps investors who can borrow at 3% to buy rental properties that yield 7%. It helps corporations that can borrow billions to acquire entire neighborhoods of single-family homes. Institutional investors purchased approximately 1 in every 7 homes sold in major American metros during 2021. They were borrowing newly created money at rates subsidized by the Fed to buy the houses that people like Marcus were saving cash to afford. Every house an institutional investor bought with cheap borrowed money was a house removed from the supply available to a first-time buyer. The price went up. Marcus's savings stayed the same. The gap widened. This is not a conspiracy theory. This is the mechanical, predictable, mathematically inevitable consequence of injecting new money into the top of the economic pyramid and waiting for it to trickle down. It does not trickle down. It floods upward into assets, and then the asset owners charge rent to everyone below them. The Cantillon Effect also explains why official inflation statistics feel like a lie. The Consumer Price Index measures a basket of goods and services weighted to represent the average consumer spending. It includes groceries, gasoline, rent, clothing, electronics, and healthcare. It does not include asset prices. It does not include the price of a house you are trying to buy. It does not include the price of a stock portfolio you are trying to build. It does not include the price of the education that is supposed to be your ticket to the middle class. When the Fed creates trillions of dollars and those dollars flow into assets, the CPI can remain relatively tame while the cost of building a life, buying a home, funding a retirement, paying for college explodes. You are told inflation is 3%. The cost of the life you are trying to build went up 20%. Both statements are technically true. The CPI is measuring the price of what you already consume. It is not measuring the price of what you are trying to become. And the gap between those two measurements is the Cantillon Effect operating in plain sight, hidden by a statistic that was never designed to capture it. Now I need to explain why this is not an accident. The Cantillon Effect is not a bug in the system. It is the system. And the reason it persists is that the people who benefit from it are the same people who design, manage, and regulate the monetary infrastructure. The Federal Reserve is governed by a board of governors appointed by the President and confirmed by the Senate. The 12 regional Federal Reserve banks are overseen by boards of directors drawn heavily from the banking and financial industry. The Federal Open Market Committee, which makes the decisions about money supply expansion and interest rates, consists of the Board of Governors plus 5 rotating presidents of regional Fed banks. The people who decide when and how much money to create are institutionally, professionally, and socially embedded in the financial sector that receives the new money first. This is not a secret. It is the published organizational structure of the Federal Reserve System. The fox is not guarding the henhouse. The fox designed the henhouse, staffed the henhouse, and writes the rules about how many chickens it is allowed to eat per quarter. When the Fed announces a new round of quantitative easing or drops interest rates to near zero, the financial media covers it as a policy decision made in the public interest, stimulating the economy, preventing a recession, supporting employment. These are the stated justifications, and they are not entirely false. Monetary expansion does stimulate economic activity. It does prevent some recessions from becoming depressions. But the distribution of who benefits from that stimulation is radically unequal, and that inequality is a feature, not a side effect. The money enters through the financial system because that is where the transmission mechanism is built. The Fed does not have a mechanism to deposit newly created money directly into the checking accounts of working people. It has a mechanism to purchase securities from banks. So that is what it does. And the banks deploy the money in ways that maximize returns for their shareholders, which means asset purchases, which means asset price inflation, which means the Cantillon Effect. The political system reinforces this because both major parties benefit from the arrangement. When asset prices rise, the stock market goes up. When the stock market goes up, the sitting president claims credit for a strong economy. When home prices rise, existing homeowners feel wealthier and more optimistic. Existing homeowners vote at higher rates than renters. No politician has ever lost an election by making homeowners feel richer. The fact that rising home prices make it impossible for the next generation to buy homes is a cost that is borne by people who are younger, poorer, and less likely to vote. The political incentive structure rewards asset inflation and punishes anyone who tries to stop it. The last Fed chair who aggressively tightened monetary policy to protect the purchasing power of the dollar was Paul Volcker in the early 1980s. He raised interest rates to 20%. It crushed inflation. It also caused a severe recession, and he was vilified by both parties. The lesson every subsequent Fed chair internalized was clear: protect asset prices. Keep the money flowing. Let the Cantillon Effect do its work quietly. And if anyone complains, point to the CPI and say inflation is under control. The media ecosystem completes the loop. Financial media is funded by advertising from financial institutions. The banks, brokerages, asset managers, and fintech companies that buy ad space on financial news networks are the same institutions that receive new money first under the Cantillon Effect. The editorial incentive is to frame monetary expansion as positive, necessary, and technical rather than as a wealth transfer mechanism that benefits advertisers at the expense of viewers. When the Fed announces a new program, the coverage focuses on what it means for markets, not what it means for the purchasing power of a warehouse worker's savings account. The language is deliberately technical: quantitative easing, open market operations, accommodative monetary policy. These phrases are designed to be opaque. They are designed to make your eyes glaze over. They are designed to make you feel like this is a complicated subject, best left to experts. It is not complicated. The Fed creates money. The money goes to banks. The banks buy assets. Asset prices rise. Your rent goes up. Your savings buy less. Wealth transfers upward. That is the entire mechanism. A child could understand it. The complexity is a costume the mechanism wears, so you do not recognize it as theft. There is a global dimension to this that makes it even more enraging. The United States dollar is the world's reserve currency. Approximately 60% of global foreign exchange reserves are held in dollars. When the Fed expands the money supply, it is not just diluting the purchasing power of American workers. It is diluting the purchasing power of every person on earth who holds dollars or dollar-denominated assets. Developing nations that hold treasury bonds as reserves watch the real value of those reserves decline every time the Fed prints. Countries that peg their currencies to the dollar import American monetary policy whether they want to or not. The Cantillon Effect operates globally, with American financial institutions as the first recipients and the global poor as the last. A farmer in sub-Saharan Africa who is paid in a currency pegged to the dollar experiences the price increases caused by American monetary expansion without receiving any of the new money. The wealth transfer is not just from the American middle class to the American financial elite. It is from the entire world to the American financial elite. And it is denominated in a currency that the rest of the world is required to use because global commodities, particularly oil, are priced in dollars. The system is not broken. The system is working exactly as designed. It is designed to move wealth upward and outward from the many to the few. And the mechanism that accomplishes this is the creation of money that arrives at the top and never reaches the bottom. I want to be honest with you about the scale of what I just described. The Cantillon Effect is not a problem you can solve with a budget spreadsheet. It is a structural feature of the global monetary system. The real solution is monetary reform, transparency in central banking, mechanisms that distribute new money more equitably, and political accountability for the distributional consequences of monetary policy. Those are generational fights. They require collective action, political organization, and a level of public understanding that does not currently exist. But that does not mean you are powerless. It means you need to understand the game well enough to stop playing it on the terms that were set for you. The first strategy is to stop holding your wealth in the asset that is being diluted. Cash savings in a bank account denominated in dollars is the single worst store of value in a system that continuously expands the dollar supply. Every dollar you hold in a savings account is a dollar that loses purchasing power every time the Fed creates new money. The interest rate on your savings account, even in a high-yield account, has not consistently matched the real rate of asset price inflation in over 2 decades. This does not mean you should have zero cash. You need an emergency fund. You need liquidity for near-term expenses. But every dollar beyond your emergency buffer that sits in cash is a dollar that is being taxed by the Cantillon Effect in real time. The first recipients of new money are converting their dollars into assets. You should be doing the same. Index funds, real estate, commodities, inflation-protected securities, and yes, for a portion of your portfolio, hard assets like gold or Bitcoin that have a fixed or predictable supply that cannot be expanded by a central bank. This is not investment advice in this specific sense. This is a structural observation. In a system that continuously creates new units of currency, holding that currency is a guaranteed loss. You must convert it into things that rise in price when the money supply expands, because those are the things the first recipients are buying with the new money. You are not beating them. You are refusing to be the last person in the chain. The second strategy is to become an owner rather than a renter of assets. The Cantillon Effect transfers wealth from people who earn wages to people who own assets. Every hour you spend earning a wage is an hour where your compensation is denominated in a depreciating currency. Every asset you own is a claim on real value that appreciates as the currency depreciates. This is why the wealthy buy real estate, businesses, equities, and intellectual property. Not because